anytime you're receiving money, just be aware that even if you think you're not dealing with a security, you might be. And so just maybe the best practice is kind of self-evident for me, but, contact the securities lawyer, because there's so many people who think they're doing a joint venture because there's 2 or 3 of you and you're not using an LLC and you're having direct title, but it turns out that you've crossed that line and somebody's active and somebody's passive and you're doing that. So that's kind of the overall big one.
Welcome to the Accelerated Investor Podcast with Josh Cantwell. If you love entrepreneurship and investing in real estate, then you are in the right place. Josh is the CEO of Freeland Ventures Real Estate Private Equity and has personally invested in well over 500 properties all across the country. He's also made hundreds of private lender loans and owns over 1,000 units of apartments. Josh is an expert at raising private money for deals, and he prides himself on never having had a boss in his entire adult life. Josh and his team also mentor investors and entrepreneurs from all over the world. He doesn't dream about doing deals. He actually does them, and so do his listeners and students. Now sit back, listen, learn, and accelerate your business, your life, and your investing with the Accelerated Investor Podcast.
So hey, welcome back to Accelerated Investor with Josh Cantwell. I'm so excited that you joined me today, wherever you are at in your real estate business, your multifamily investing. Maybe you're home hanging out on the couch, getting ready for bed. Maybe you're in the gym, out for a walk. Thank you so much for engaging with me and spending time with me, an Accelerated Investor. I have a special treat for you. It's one of my favorite topics in the world to talk about private money and private capital. I have a special guest today. His name is Mauricio Rauld. He is one of the premier real estate syndication attorneys in the country. He's a relatively new contact and connection of mine, so I'm excited to interview him and talk to him today. But I see his stuff all over social media. He speaks at massive live events around the country. He's been featured on many other apartment, multifamily, and syndication podcasts, and I feel very privileged to be interviewing him today. His name again is Mauricio Rauld, and he is just going to blow your doors off with content and information around raising private money, specifically for multifamily. Mauricio, what is going on? Thanks for joining us today on Accelerated Investor.
Thanks for having me, Josh. Thanks for having me, my friend. Really appreciate it. I won't make fun of the fact that I'm in sunny SoCal and you're in rainy Cleveland, but it's all good.
You just did make fun of it, so we got that past us. That is fantastic. So your law firm is exclusively focused. One of the things I love about your bio and my chance to connect with you is niche is rich, right? And you created a niche. There's lots of things that you can do in the securities world. You're focused exclusively on multifamily syndication. So for our audience that doesn't know you or doesn't know what multifamily syndication is, give us a quick 30-second background on you and your firm. And then just describe for us, in your own words, what's multifamily syndication?
Yeah, so I'm a syndication attorney. 100% of my practice is syndications, and like 99% of my clients are real estate syndicators. And I started this firm. I've been doing this for now 20 years, but I started my firm about 15 years ago, and exclusively on the syndication side, probably about 8 or 9. What's kind of fun for me is I've kind of gone through, started working at a law firm, kind of did that thing, working on the litigation side. So I did all the sort of the complaints and the motions and trial work and appellate work and depositions and motions, all that stuff. And then I left that great law firm, but I left to go in-house for I don't know if you guys know the real estate guys, but Rob and Russ, who do a lot of work, I worked in-house with those guys, and then started my practice right after that. And one of the things I really enjoy about it is that for the first time in my legal career when I started this is that we're all aligned, right? Like when you're doing litigation, like everybody's butting heads and everybody wants to sue each other. Yeah, it's like a fight. And here it's cool because everybody's aligned. Everybody wants to work with me because in order to get their syndication done, they need the legal piece. But at the end of the day, what I tell people is the syndication is a puzzle, right? The syndication is the act of raising capital to go buy something. And in my world, it's to go buy real estate and multifamily primarily. And so I'm the legal piece, right? So I like to show people how the legal piece fits into the overall syndication puzzle. And that's what I enjoy doing. I enjoy, speaking at these events. And, my good friend Tom Wheelwright likes to say that I'm one of the few attorneys that actually speaks English, which is, so that's my thing. I like to take these complex securities matters and make them easy to understand. It's a lot of fun for me, and it's been quite a blast the last 4 or 5 years, just kind of going on social media and getting out there a little bit more.
Yeah, then that's originally how we connected. I saw some of your content, some of your own posts, and I was, kind of stumbled into it, which is what social media is all about. It's social sharing, and somebody shared it or you did, and I'm like, okay, this is really good stuff. This guy really knows what he's talking about, and I have a fair amount of expertise, so I was digging in and listening to what you had to say. I'm like, really enjoying it, and just reached out and made the connection. I saw Tom speak, by the way, at the Capitalism Conference, CapCon, which was awesome.
Oh, yeah.
Yeah, I was there as a speaker as well. He spoke, I think, on day 2, and I was there on day 1, and we were talking about, multifamily investing and some different opportunities in real estate for those e-com business owners, guys that own e-com companies. And Tom spoke about protecting their assets and also trying to zero out their income taxes, which is pretty cool. So Mauricio, let's talk about best practices. Obviously, this whole concept of general solicitation, Reg D, 506C, and different opportunities with Reg A+, some of these different regulations that are out there that allow people now for the first time to recruit capital and use general solicitation as an opportunity. We'll talk about that in a minute, but in general, when you're consulting with a client who's doing a real estate syndication, what are some of the best practices, things that somebody should be checking off the boxes right when they get going to make sure that they can successfully and legally raise money for their multifamily deal?
Yeah, great question. I think one of the first things that I like to point out, because it's not obvious to many, is first of all, take the securities laws seriously and recognize that sometimes you might be doing a syndication and not know about it, okay? There's a lot of complicated ways to describe when you're actually doing a security or issuing a security. But at the end of the day, anytime you're taking money from someone where the returns are generated by your efforts, anytime you're taking money from an investor where the returns are generated by your efforts, you are dealing with a security. And I don't care if it's a joint venture, if it's a profit sharing agreement, people trying to get creative. It's only my brother-in-law. All these creative ways that the structure itself does not matter. And a lot of times I'm talking to clients and they're like, well, it's not really a syndication. We're going to do it this way. And I'm like, no. That doesn't matter. What matters is who's generating the results. And if your investors are passive and you're active, then you're dealing with the security, which means you've got to comply with securities laws.
Right. And so best practice is basically to think, okay, again, if the passive investor, limited partner, their return is based off of my efforts, that is a security. Now let's get compliant, right? That's the first box to check off. That's the first thing.
And just be aware of it. Like just anytime you're receiving money, just be aware that even if you think you're not dealing with a security, you might be. And so just maybe the best practice is kind of self-evident for me, but, contact the securities lawyer, because there's so many people who think they're doing a joint venture because there's 2 or 3 of you and you're not using an LLC and you're having direct title, but it turns out that you've crossed that line and somebody's active and somebody's passive and you're doing that. So that's kind of the overall big one. I think the other best practice that I've been talking a lot about lately is the social media. You and I are pretty active in that world. And everybody's on social media, obviously, which they should be. It's a great platform. Right. But when it comes to the securities laws, you just got to be really, really careful when you're on social media, especially when you have an active deal. So when you have an active deal, I really encourage folks to kind of stay away from social media in terms of posting about the business or the deal or what have you, because I think most people understand you can't post your deal on social media. I think that's obvious. You can't say, hey, look, I've got $1 million. I'm raising $1 million to go buy an apartment building. I think most people get that. But what most people don't understand is that there's something called conditioning the market, which means even though you're not specifically talking about your deal or what you're doing or whatever, if you're if it's perceived that you're drumming up excitement about your deal, that could be considered conditioning the market, which means you're advertising for your current deal for sure, and potentially your next deal. So, for example, you're at the property, all these posts of people at the property doing their due diligence, and they're sneaking in there, hey, I've got a deal going, right? It's obvious to me when I'm looking at the post that they're in the middle of a raise and they're talking about the due diligence and, how great it's going and how great of a deal it is and how they're going to make a bunch of money for their investors. Even though you're not saying, hey, I'm raising money, give me money or call me, that's going to be considered conditioning the market. So the only thing in terms of best practices that you want to be doing on social media when you have an active deal are really posts that add value. If you can post something that purely adds value, like why Cleveland, do a report on why Cleveland, Ohio is the greatest real estate market of all times, and you think it's just poised to go off the roof, right? That's got nothing about your deal. It's about why real estate in general is the greatest wealth building vehicle of all times. Why, you should pick a really great property manager, whatever. Just pure value add, that's clearly fine. And that's, to me, that's the way you grow your list and get people to know you. The other thing you can do, which is also tricky, is just factual information about your deal. Factual information about your business and what you do, in theory is fine, but here's the tricky part. If you're consistently posting on your business kind of quarterly updates or monthly updates or whatever, that's fine. But what I tend to see a lot of is there's crickets for 8 months, and then suddenly a week before your grade, you're suddenly out there, pummeling fake social media about your business and this, that, the other, and you're like, hey, I'm just talking about my business. And yeah, that's true. But then when the deal's over, you go back to doing nothing. And so if you look at it, it's kind of like a bell curve, right? You got nothing, then it suddenly spikes and goes, that's not a good thing either. But if you can consistently talk about your business and what product or services you do, the SEC has definitely said that that's fine.
Got it. Yeah, love it. In my newest real estate investing book, The Flip System, you'll learn the proven secrets and strategies that I've used to be a successful real estate investor. You'll also hear the story of my journey from quitting my job to doing over 2,000 units of apartments. The Flip System is now available for a limited time, and you can grab your free copy at getflipsystem.com/podcast. You'll learn the same proven principles and secrets and investing strategies that I used to quit my job and pursue a life of financial freedom. In this book, I'm sharing exactly how I was able to personally close over 750 profitable real estate deals, make over 400 private lender loans, raise over $30 million, and acquire over 2,000 units of cash flowing apartments. Get my newest book now for free at getflipsystem.com/podcast. That's getflipsystem.com/podcast. I'm curious to hear your take, Mauricio, on best practices so everything we just discussed is around the idea of not doing general solicitation, right? It's around maybe a 506B registration or exemption, and you're building relationships with people, you're getting to know them, and you're having a prior substantial relationship before you make the offer. Now, again, there's sort of a best practices for the opposite, which is 506C, where it's I can post on social media, I can solicit investors for my deal, I can make the offer online to a stranger and post it everywhere I want. Of course, the hook there, or the exception, is I've got to take money from accredited investors only. What I find is that, unless somebody has a relationship with me or has a relationship with the deal or has a relationship with the operator, they're probably not going to invest in that deal anyway. But have you seen people that you've consulted with or worked with, have you seen people successfully use social media or successfully use email marketing or video marketing for a 506C raise? And how have they done that, where they were able to take somebody who's maybe a stranger or somebody that's just on social media and actually successfully get them to make the investment in a deal? Have you seen that work before? And the question I'm asking is, I haven't personally even tried it yet, so I'm curious to see if it's working for anyone.
I definitely have a tip for a best practice on that for sure, but let me just give you a general comment. I think it's really difficult to get investors the first time they see you on social media. Getting investors, as you know, Josh, it's a long-term process. It's an ongoing process. And in fact, the best time to find investors is when you don't have a deal. But it's just consistently getting on social media or whatever your marketing channels are and consistently providing value and giving folks information about what you're doing. It's not hey, I've got a deal, now I've got to go find investors. It's probably the worst way you can raise money. You've got to have the money basically raised before you get a deal in an ideal world.
No doubt.
Almost impossible, I think, to put an offer which you want to be careful to as well, because in a tweet, for example, you don't have that much space to put any kind of disclaimer in there. So even with the social media postings, you want to be a little bit careful. You certainly want to be telling the world that it's a 506C so that nobody gets the wrong idea. I think the strategy that I've seen that probably works the best is using social media to advertise a webinar. Using social media, not to directly pitch your deal, but to do a webinar either on your deal, which would be one way, or just an educational, again, why really, if you're new to real estate, I'm doing a webinar next week on why real estate's the greatest thing, and you can bombard social media with ads or whatever and get people to the webinar, get their email address, and then start that relationship. And I think that's probably, in terms of best practice, something that has worked. I have seen that work. I've seen my clients live stream. I've had clients live stream their presentation meetings or their meetups or whatever. So, but putting an ad in there saying, hey, I just closed on I just got in a contract to a 200 unit apartment building and I need $2 million. Call me. Probably not. I'm not saying it's impossible, but it's probably not best practices. Let's put it that way.
Yeah. It's interesting. I teach that same model. We do that same model, which is build the relationships first. And even when people ask about deals, the most powerful thing you can do is to tell people, well, these are the deals I've done before. Like, this is how a deal is typically structured. And oh, by the way, I don't have a deal right now. But if we come across a deal like this in the future, and assumes that we have a relationship with them, are you interested in something like this? And people say, yes, I'm interested. I've got money to work with. I've got $300,000, $500,000, $100,000, whatever it is. Then when you have a real deal come on and you're under contract, LOI, you're under contract, you're doing due diligence. Now it's time to raise, to take all those people that have previously made sort of a soft, interest or a soft commitment and get them onto a webinar and say, look, we have relationships now. I need to raise $2 million. But oh, by the way, there's 50 people on the line. And I only need 20 units at 100,000 each, or 10 units at 200,000 each. Because now, instead of begging for money or trying to quickly create the relationship, it's the opposite, where you have the goal that everybody wants, and you have sort of a feeding frenzy of people that are like, I want a unit, I want a unit, I want a unit, I want a unit. You'd rather be in that situation than the opposite, which is now you're broadcasting on social media, hey, we've got a deal, it's gonna be fully subscribed any day, right? I've seen that too, where people are like, hey, we've got this deal, it's an amazing deal, we're almost fully subscribed, but they're almost fully subscribed for like 6 weeks, right? You've seen that too. So it really comes down to building relationships as part of your business, right? That's one of the locomotives going down one of the tracks, is build relationships, provide value, then go find deal flow as well. The trouble is, and I don't know if you have any thoughts on this or best practices, is it's tough to match up the two locomotives going down two separate tracks at the same time. Have you seen successful syndicators? Do they have a team where maybe part of the team is raising money, part of the team's finding deals? Or what have you seen work well in that way? Look,
well, you hit it on the head, obviously. You've been doing this for a while. It's all about relationships, and relationships don't get formed overnight. It takes time. It takes effort. It means you getting out there and putting yourself out there in meetups and social media, whatever. So typically, that's the best way to do it. I think if you're just starting out and you don't have those relationships, what most people do, and I think this is another great best practice, is team up with someone who has that experience, so that you can not only learn from their expertise, but again, you're kind of bringing in their network that have more of an established network. And even if you're working for free or for peanuts, everybody's got to pay their dues, because it really is. I do have people who start syndication and they don't have the money raised, and they're like, oh, I don't know, I got to go raise $1.5 million, and I don't know where it's going to come from. And suddenly switching to a 506C in my experience, I haven't seen it work. You really do want to be entering into relationships throughout the entire year. And like you said, I think it's even better to do it. It's actually more effective, in my opinion, to speak with a prospective investor when you don't have a deal. Because they know it's not coming. They're not expecting, hey, look, this guy or gal's going to ask me for money. It's just, they're just telling me, just like you said, hey, this is what I do. More importantly, what can I do for you? What are you interested in, Mr. or Mrs. Investor? Are you looking for cash flow, short-term, long-term, equity? What are you looking for? And then just like you said, hey, if I find something like that, is that something I can share with you? And they're, of course, going to say, yeah, absolutely, shoot me an email. So then when you get it, you have warm people or people you've talked about. The other thing best practice, if we're going along these lines, is I always tell my clients, continue to talk to your email list. Hopefully everybody's out there getting emails and it's not just social media. They're somehow capturing emails, but consistently talk to your list, because the last thing you want to happen is have a deal come in and then that first email is the first time they've heard from you in 6 or 7 months. You want to be continuously adding value. One of the great tips I heard just this year was share with your audience deals that you're passing on. You know, if you're doing the underwriting and you can go, look, I've gotten these deals. Here's a great deal that I came up, but we're passed on it because of these reasons. You know, it was overpriced or whatever. It does two things. One, it adds value to your list, but it also lets the list know that you're out there trying and looking for deals, so that when you finally do come to them with a deal 3 months down the road, they know you've gone through 100 of them, and this is now the prize. You know, you found the needle in the haystack. This is it. As opposed to the opposite extreme, like I said, they haven't heard from you in 6 months, and suddenly like, hey, I have a deal and I need money. When you come from a place of need, it's always going to be much harder.
Right. Yeah, I love it. Mauricio, I'm curious to hear your thoughts. You know, real estate syndication, big apartment deals are typically one large joint venture. You know, you typically don't have one guy or one gal that finds the deal, raises all the money, does all the due diligence, sponsors the loan, signs the personal guarantee, does the asset management, does the boots on the ground, and does everything. Also deals with the syndication lawyer like yourself. Usually it's a big joint venture. And so what would be some thoughts or tips or best practices, again, for somebody that's getting in, that's maybe not doesn't have an expertise in raising money? So they know they've got a great deal, maybe a deal under LOI or contract, and they really don't have a lot of contacts at all, but somehow they maybe stumbled into this amazing deal, or maybe they have a great contractor and they've convinced the pocket listing commercial agent to give them a shot at this deal, and they win it, but they have very little capacity to raise money, right? I know you're very outspoken on social media about you can't pay someone a commission to just raise money. So I know there's a best practice around this. And so really, I guess this answer I'm searching for comes with kind of two questions: is what different roles can people play in this real estate syndication game? And what if you have an amazing deal, but very little capacity to raise money?
Yeah, as you know, I feel like I'm a broken record on social media. I've really been hammering it hard, and I'm not. I
love it, by the way.
I'm not apologizing for it anymore. At the beginning, I felt kind of bad, but I'm like, you know what? I think when you look back years from now, it's going to be fun to play these videos and show people that my concerns were there. So best practice again. Just be aware. So I'll just repeat it really high level. I won't get into the details, but just be aware that you cannot pay somebody to raise money for you. Okay, you just can't do that. They've got to be licensed, and FINRA, a licensed broker dealer, which obviously they're not. So the way around that, it's not really a way around that, but the way you are able to compensate people is you've got to bring them in as legitimate co-sponsors. And by legitimate, I essentially mean they're doing the thing. They're helping you. Look, one person may not be able to do everything, so bring them in to help you with the underwriting or the asset management or the investor relations or a combination of them all. But they have to be doing substantial work, and their primary responsibility needs to be the work. It can't be raising the money. So as long as, when you've got one partner, I think that's fairly easy, or even 3 people, I think that's really easy. I think where it gets a little bit tricky is when you have 4, 5, 6. I mean, I've seen some of these that have 9 or 10 sponsors, and it's like, it's just going to be a hard sell to say that all 10 of you were actively involved when somebody out there is raising a bunch of money and they're not doing anything, yet they're getting compensated. And compensation in the form of the GP or shares in the company is just the same as cash. I mean, it's a form of compensation. And so you cannot pay somebody that's compensated, it's tied to the amount of money you're raising. You've got to be a legitimate co-sponsor.
Yeah, got it. Are you ready to automate and explode your real estate investing? We're searching for extremely motivated individuals who are sick and tired of wasting time and want to finally see real results from their real estate investing business. We're searching for investors looking to get to the next level and become a bigger, better version of themselves while being a more successful real estate investing entrepreneur. Apply for mentoring and coaching at joshcantwellcoaching.com/podcast. That's joshcantwellcoaching.com/podcast. I guess, again, it comes back to relationships. If you're great at finding deals, then start talking, start networking, start working with people that are good at raising money and good at people who are also good at underwriting, maybe co-sponsoring, maybe it's signing the PG on it. But work that out ahead of time, that you know that, hey, I've got certain qualities or certain skill sets. You have certain qualities and skill sets. Let's mash those together before we go lock a big deal down, instead of, because I've had people approach me before and be like, I've got this $10 million deal. I need to raise $2.5 million. I'm $750,000 short and I'm closing next week. Can you raise money for me?
Right.
And the answer is no, sorry, I can't, unless I'm involved in some other way, like unless I'm involved in the underwrite, but you've already got the underwriting done.
Right.
Unless I'm going to sign as a PG on the loan, or you already have somebody signing the PG. It's like, I can't do anything else to legitimize my full-blown partnership here other than just raise money, so I'm out. Right? And that's the way I've got to approach it. I've passed on many, many, many big deals where guys are like, I know you manage a lot of money. I know you can raise a lot of money. Can you just raise money for me? Sorry, can't do it. No way. It's just not worth the risk, right?
Yeah, I mean, let me just commend you for that, because it's really hard and it's really frustrating, because let's be honest, everyone's doing it. And so when everyone's doing, it's like the social media, everyone's doing it. And so when everyone's doing it, it's really, and I'm trying to tell my clients, stay in your lane, stay in your lane. And because we've had such a great run over the last 10 years, things have been going fine. But the minute things start, I don't think they need to go down. As long as things start tapering off and now you don't get that rent growth that you desperately needed, maybe you just flatten out and people are going to start losing money. And it's already happening, by the way. I've already talked to a lot of my clients who are seeing these issues where the sponsors have had the asset now for 2 or 3 years. They haven't been able to get the rent growth and the bank's basically foreclosing on them. And I'm like, man, if you can't make money in this environment, I can only wait till the things start to be challenging again. So when that happens, and I don't know if it's going to happen next week or next year or 10 years from now, I don't know, but I know it's going to happen at some point. That's when investors start to lose money. And when investors start to lose money, that's when they pick up the phone and start complaining to the regulators. And that's when your world starts collapsing, because the regulators will reach out to you. They'll ask you for your documentation. And at that point, they'll go through. Nobody's looking at your social media feed now. Nobody's checking to see if your sponsors are doing everything. But the minute there's an investigation opening and they're going to be talking to your investors, and your investors, trust me, they've lost money. They're not going to be on your side. They're going to say every single thing that's going to show how you were advertising on social media, or like, this person convinced me to go in the deal and it turned out this person didn't do any work at all. They just raised the money. So
no
that's
doubt.
my broken record. That's my rant.
I love it. I love it. I find the more and more kind of going off on a little bit different tangent about building relationships. I think there's so many people who are going to events, meetups, webinars. The best place to make relationships is face-to-face, right? So the best way to sell is face-to-face. So if you can't get on a stage, if you can't speak in front of an audience, go to those places anyway and meet people in the back, meet people in the hallways. The second best way is webinars, Zoom, podcasts, webinars, because you're selling. It's not quite face-to-face, but it's kind of digitally face-to-face. That's a great way. I would encourage people, look, even if you've only done 10 single-family home flips, you've done 10 more than the other guy. Right? So you got to get out there and build that audience now and talk to people. And what I love to do, Mauricio, I'd love to hear your take on this, is, again, I go and educate my audience. It started with friends and family. It's mushroomed out from there on a big scale. But I talk to people and say, like, this is what we do. Here's previous deals that we've closed. They've looked like this. Again, I don't have a deal that you can invest in right now. But I take the approach of, I'm not assuming that you're interested in this at all. So all I want you to do is keep me as the top of mind reference in case you know someone else who you think would want to learn more. And what I find people saying is, well, Josh, like, all the stuff you just taught me and showed me, what about me? I'm right here, I'm interested. And by taking the approach that they're not interested, by taking the approach that they don't have money, it totally takes the pressure off, so that when I actually have a deal, they're like, well, I didn't think you'd be interested at all. I had no idea if you'd be interested. You're interested. Now they're really in because they've convinced themselves without me convincing them. They've convinced themselves that this is something they want to do with their money.
Yeah.
So I don't know if you have any thoughts around like the actual appointment, the actual face-to-face, the actual speaking to a private lender. Again, best practices on the way to kind of present a deal or not present a deal. I know you've done it a lot. You have clients that do it. I found it just better to kind of slow roll it than to steamroll through it, right?
Yeah, and that reminds me of one of our best practices that we like to share is look, if you've got especially if you have an individual who's got a lot of money, you can always go to that person with your business plan and approach it not in the approach of asking them for money, but asking them to review, their experience. Hey, do you mind reviewing my business? I'm not looking, you're not looking for any money, but can you give me some feedback on my business plan? And genuinely try and get some feedback from that person. And if it's a good deal, again, there's no pressure. They're not asking you for money. They're just going to review this business plan. And they may be like, hey, look, this actually sounds like a good deal. I might be interested. But at the end of the day, again, it comes back to relationships and adding value. You've always got to focus on your investor. It's not about you, it's about the investor, right? So you have to add value to them. So the first thing you need to understand is what they want. Like, what can you offer them? Are they busy professionals? That's why a lot of my clients are doctors, for example, and they cater to busy doctors because they know their pain points, right? They know that they're super busy. They're working 100 hours a week. They're in the hospital. They don't have time to go research this. And so they come to them from that point. Look, you've got a lot of money. You don't have a lot of time. Let me do that work for you. Let me add value to you. Let me sift through all these things. You just have to write me a check. And then other people may need tax breaks. Maybe that's their primary motivator. So now you go to them at a different angle and say, look, you have a tax problem. You're a high-paying professional. Real estate can help you. I've got this deal that has bonus depreciation, or maybe it's an oil and gas deal, whatever deal that has a thing. So you always want to come from the position of what does the investor need? What are they looking for? And making sure you have the right fit for them, not the other way around. You don't want to have your product and try and jam it down somebody's throat. You want to be coming from the position of what do you want? What are you looking for? How can I help you? And then when they tell you, have something ready for them for that, because that's how you make it happen.
No doubt. So Mauricio, rounding third here, head for home. I've got one final question, which is, a lot of my audience might see this podcast, this YouTube video, and say, "Wow, like I've got a syndication. I'd love to talk to Mauricio about like what does he do? How does he operate?" So help me understand when you do take on a client. Hopefully, I work with you on a deal. So I'm kind of asking this for selfish reasons too. If we work on a deal, or one of my listeners works with you, what should they expect in that first couple days, couple weeks of a relationship with you? Let's assume that they have a deal, or assume that they want to start to do a raise. How do you help them kind of frame up the deal, or how do you help them describe the deal in a private placement memorandum? What should they just expect when they're working with a securities attorney, especially if they're building a new relationship, that first couple days, weeks of that relationship? How do you build that relationship? How do you start to write the business plan, pour that into a PPM?
Yeah, so great question. So we have kind of a unique process, and the two things that I focus on, one of our core values is I'm just customer obsessed, and so I just want to make sure my clients are taken care of. The main thing I look for is communication. Just make sure I'm over communicating. But the first step is really it's actually the client who puts together a business plan, and we help them, answer the questions as structure. We help them structure, but we spend a ton of time on the front end helping the client either put together the business plan, not the private placement, the business plan, the pitch deck, the executive summary, whatever you want to call it. Spend a ton of time on that, and then helping them put it together. And then when we get that first draft, man, we look at that thing and tear it apart line by line. We have 1,000 questions, 1,000 comments, because the only way, in my opinion, that your securities attorney knows what to put into the PPM is by asking you 1,000 questions and having 1,000 comments. If they just send you a questionnaire and they just kind of fill it out, and it's going to be kind of a templated, like, your deal is unique. And the only way I know to find out and pull that information from you. Get on the phone, review your plan, ask you questions, and get that information so you can put it into the PPM, because a PPM that doesn't have all the information in it is kind of worthless. So we really just work hard on the front end and with the consulting piece and helping clients put their structure together, and then ultimately, underwriting essentially their business plan so we know what goes in the business plan and the PPM. And then we just like to do a really fast turnaround, because the last thing that we want is for our clients to have investors ready to write checks and the docs aren't ready. So we do a 1-week turnaround, which I think is think it's probably the fastest around, but that's what we try to do.
Music to my ears. 1 week, 1 week turnaround. Now, guys, I just want to explain again to our listeners, the reason why this business plan and private placement is so important is because, again, if there's a downturn or if somebody loses money, they complain to a regulator, it's going to become a he said, she said, right? And the only way a regulator can know, like every business deal has risk. And the SEC and regulators, they know this. They know that there's risk. So if somebody loses money, it just doesn't mean that they're going to take the person who's complaining. They're not just going to take their side, right? Because they're complaining against the big bad company that took their money or they lost money. The reason why this is so important is because if you're sitting in front of a regulator, sitting in front of a judge and jury, and they're really doing a deep complaint about your business model, the he said, she said can be eliminated by these documents being in writing. The business plan, the private placement, the executive summary, the subscription agreement in writing with all those disclosures. So it's Mauricio's job and his firm's job to pull out all this information so they can make full, fair, and adequate disclosure. Because if there's full, fair, and adequate disclosure and someone loses money, then that's just business. If there's not full, fair, and adequate disclosure and something's withheld, that's called fraud, right? So Mauricio, any other final thoughts on that piece?
No, you hit it on the nail. I mean, it's all about the disclosure. One of the things I love about syndication in general is you can be as creative as you want to be, right? And I love that structure part in the beginning, the consulting, because we can be creative. You can structure this however you want, as long as you disclose in that PPM, and that protects not only investors, making sure that they're making an investment, with fully aware of what's going on, but it also protects you as the sponsor, because now if something does go wrong, you can just say, hey, look, page 75 over here on the bottom, I let you know that, maybe this is a bridge loan and we may not get another loan and we had to fire sell it because we couldn't get permanent financing. And I disclosed that risk to you. You knew about it. But if they have something go wrong and it's not in the PPM, that could be problematic.
Sure. Love it. So Mauricio, I know you got to run. Thank you so much for all this content and information. I know some of my audience is going to want to reach out to you, connect with you, engage with you, get some more information about you and your firm. Where can they get more information or connect with you?
Yeah, probably the best way to connect me is just shoot me an email at team@premierlawgroup.net, team@premierlawgroup.net. Also started a YouTube channel, Mauricio Rauld, if you want to check that out. I'm dropping a lot of videos there.
Fantastic. Yeah, we'll put that in the show notes. Also on our blog, acceleratedinvestorpodcast.com, YouTube. You'll find this everywhere podcasts are found. Mauricio, listen, so much fun, again, building our relationship and getting to know more about you and your firm and talking shop about syndication. Thanks so much for joining us today.
Thanks for having me, Josh. Appreciate it.
You've been listening to Josh Cantwell and the Accelerated Investor Podcast. Leave a comment on our iTunes channel and let us know what you want to learn next or who you'd like Josh to interview. While you're there, give us a 5-star rating and make sure to subscribe so you can be the first to hear new episodes. Follow Josh Cantwell and his companies, Strategic Real Estate Coach and Freeland Ventures, on all social media platforms now, and stay up to date on new training and investment opportunities. To start your journey toward the lifestyle you've always dreamed of, apply for coaching at joshcantwellcoaching.com.